Hey everyone, welcome back to the Daily Gold Podcast. Today we're speaking with Pete Doherty. He's the president and CEO of Argonaut Gold. Hi Pete, how are you today?
Good morning, Jordan, and thank you for having us on. Things are going good in the company and excited to look forward to 2013.
Yeah, last year you guys produced over 100,000 ounces of gold, and in your recent release you guided for 120,000 to 140,000 ounces for this year. Can you tell us why there's a wide range there and what you need to do to achieve production growth at both of your mines?
Right, okay. I'll try and keep this succinct, Jordan, but when we looked at last year, it was an amazing breakout year for the company, obviously achieving over 100,000 ounces of gold. When we originally looked back to the guidance, we were signaling to the street between 90 and 95,000 ounces of gold production for the company. Obviously, we achieved better. A couple of things went in our favor. One was a grade reconciliation out of the mine at El Castillo. We are expecting to produce at an average range of 0.33 grams per ton, and yet we came in averaging over 0.36 grams per ton. So that really helped us. That coupled with greater recovery at the La Colorada property, where we were expecting somewhere around 40% recovery would yield 13 to 15,000 ounces. In true reality, we got closer to 20,000 ounces. So as we looked into 2013 and what life could bring us, first off, we start to look at El Castillo. And at that property, the models are predicting that the grade will drop to 0.31 grams per ton. So in order to see an uptick in overall production, which we are planning at the El Castillo property, we'll have to process additional tons. So if you could see a 15% drop in grade, you're going to see we have to make up considerably in the amount of material that we're going to process. At the La Colorada property, we received the blasting permits late in the year last year. We were hoping to receive those mid-year last year, but they didn't come until November. That delayed the opening of the new pit, the La Colorada Grand Central pit, and has delayed the head grades that we'll be processing till the latter half of the year. So our production is heavily loaded towards the second half of the year. In order to achieve that production, and why we have a wide range is, we can never signal for sure what's going to happen from the mine planning. I mean, we expected 0.33 last year. We got 0.36 at El Castillo. This year, we're expecting 0.31 grams per ton. If we do better, that will be all the better for our shareholders. At the La Colorada property, it all depends on how rapidly we can get this mine opened up, and we are going to push as hard as we can. But the expectations are production will be 30 to 40,000 ounces this year at that particular property. So that's why the wide range. As we look at operating costs, last year we had predicted between $6.25 and $650 per ounce. As we look to this year, we're looking between $630 and $660 per ounce. So we think we've been able to hold the cost in check as well as deliver on an increase in overall production for the properties.
And now let's talk about Magino, which of course you guys acquired with Prodigy Gold last year. How might your upcoming pre-feasibility study for that property differ from the studies that Prodigy did in years past?
Well, Jordan, it's a very exciting project for the company, as you know, and many of your listeners know. We completed the transaction just in mid-December, so we've just had a short time that we have controlled the property. We've obviously been on site for quite some time watching and seeing that property as it moves forward. Last week, we actually put out roughly almost 90,000 meters worth of drilling at the particular project. And one of the things that's key in what we saw is that most of our mineralization, over 90% of our mineralization, lies in what we call a little thin slice that was depicted in our overall graphics of granodiorite type rocks, similar to what we're mining down in Mexico at our other two projects. And then as we start to step out from that, we see what we call a metavolcanic, or an older type rock, much tighter and harder, and we didn't think we were going to see any mineralization there. In fact, in all the studies that we have looked at, we considered that to be waste rock. In the drilling that we released last week, we were fortunate enough to hit mineralization in this rock. So a couple things are happening. As we've always talked about from day one, we see the Prodigy studies that were put together for the Magino property, indicated a mine that would process roughly 20,000 tons per day, produce a little over 250,000 ounces annually at a cash cost of sub $500. That yielded an NPV somewhere north of $900 million on this particular project, a nice IRR of over 36%. We said we were going to look at a much smaller pit. So in the large pit, there were over 6.3 million ounces to be processed. In a smaller pit that we said we could look at is if we change the cutoff grade here, we might be able to look at a smaller processing facility, something where if we change that cutoff grade to 1 gram, overall tons to be processed would be around 50 to 60 million tons versus 220 million tons. Well, with that brings higher grades, greater operating flexibility as we would be mining for the heart of this particular project. And when we look at that in relation to what the Prodigy team had put together, it would be a smaller processing facility than the 20,000 ton per day facility. And we haven't disclosed yet what type of processing facility we would be preparing. An analyst that had at one time put out a study on this was Craig West at GMP, and he talked about somewhere in a 10,000 ton per day facility. A 10,000 ton per day facility would yield roughly 190,000 ounces per year at a cash cost somewhere around $575 per ounce and costs roughly $400 million to build. We think that's a good starting point for most people. If you look at the metal price that he used, which I believe was $1,575 per ounce, that yielded an after-tax NPV at 5% discounted of nearly $725 million. We think that we might be able to improve upon that, but it's still early days, and we expect to be releasing sometime during the summer a new pre-feasibility study on this particular project. But very excited by the recent drilling and what's happening at the project.
Now, Pete, let's just talk about acquisitions in general as far as the industry, because everyone nowadays is obviously looking for the low cost and high margin deposits. I mean, in your opinion, is it still really possible to find these types of deposits, or will acquirers have to inevitably lower their expectations a bit?
Obviously, it depends where we are in the cycle for the market as a whole. Right now, we've relatively recently seen the overall valuations for companies shrink significantly. Now, what that means is that we're going to have a greater emphasis on capital rationalization. What that means to us and many other producers and people looking to grow is that what you'll find is that the better projects will move to the top of the table. You will find that the projects that are a struggle at this point in time may not make it past that exploration and development stage and either simply move away and just go into hibernation for a while, or they may be able to be moved forward through an acquisition. So when we start to look at where things might turn out over the next 6-9 months, next year and beyond, I think what you're going to find is that the quality projects will have legs underneath them and be able to move forward, either through acquisition or through the companies being able to enhance that project forward through either debt instruments or further capitalization of the projects. Now, those projects that are struggling, I think it's going to be a very challenging time for some of those projects where they may have to just step back for a while on their development plans and wait for things to change in the future. How's that play out for us as a company that would like to grow? I believe it provides significant opportunity for us. And it presents an opportunity not only for us to grow through adding acquisitions on, but also potentially adding on talent onto the teams that we have already in place. So I like where we are in the market today, fully cashed up with the ability to continue to build through our existing cash flow, which was positioned as well at this point in time.
You know, my next question, you touched on this a bit, but I mean, given the decline that we're seeing in the gold market, does that make assets more attractive to you, or is everything relative? And just another point on that question, I was looking back in regards to the number and the value of acquisitions, and they tend to follow the market itself with a lag. I mean, more acquisitions were being done when the market was hot, and then at the lows, there were fewer acquisitions being done. Do you think we'll see that trend continue, or could it be different this time because of the potential values out there?
I think that we're still looking at the latter situation, just because when we step back and we have to look at all the companies today that are quality companies with the financial capability of being able to take on the acquisition, or the human capital to be able to take on that acquisition to be able to move it forward. I think that we're talking about an industry that is not very robust in that category at this point in time. And so if you have a lot of players in that field, you would see M&A increase significantly. If you have a few players, that's going to mean that we're going to see probably a smaller amount, but that the acquisitions that will be done will be highly accretive at the end of the day.
Okay, Pete, now before we close, is there anything you want to speak about that we haven't covered here so far today?
You know, I would say, Jordan, just one thing for your listeners. As we look at this gold market that we're in today, I think the emphasis on management teams, the emphasis on focusing on returns has come to the top of the table once again. And I think that's healthy for our sector. It will not only bolster the strength of the sector, but also bolster the strength of the investors back in and the confidence of the investors back in. I see this as a potentially great acquisition time frame, not only for us, but also from an investor standpoint. Never in the cycle have we seen the multiples of gold mining stocks being at the level that they are at today. That provides significant leverage to the future. And I believe, I'm still bullish on gold. I believe that it has a place not only today, but also in the future, and it will be stronger. And therefore, that leverage that is there for the investor is significant today with these all-time lows that we see in the market today. So I think it's a tremendous opportunity at buying time, not only for ourselves, but also investors.
Pete, thanks so much for your time today. I and my listeners really appreciate it, and congratulations on Argonaut's success thus far, and all the best of luck to you in the future.
Okay, great. Thank you very much, Jordan.